Thank you very much for taking time to listen to this message today. I am Karaoka, Representative Director, President, and CEO. From now, please let us explain the financial results for the third quarter of the fiscal year ending on January 31st, 2026. First, we would like to explain our recognition and analysis of the recent slump in the stock price. We would like to express our sincere apologies to our shareholders for the current slump in the stock price. The entire management team shares a strong awareness of this situation, and after careful consideration, we have decided to revise our strategy and implement a share repurchase, which we will explain later today. Here is the chart which shows the performance of Genda's stock price since its listing. Our share price increased 3.5 times from the initial offering price of 442 yen at the time of listing and has been in an uptrend for about 20 months since listing. However, as shown in this chart, the stock has been in a downtrend for the last 8 months since the Trump shock in late March of this year. Through ongoing dialogue with many investors, we recognize the following 3 points as the main cause of this slump in the stock price. At today's financial results briefing, we will explain each of them in detail and our response to them. The first is the concern over the M&A of Player One in North America. In late March 2025, under the market environment of the Trump administration's tariff shock against China, we announced the M&A of Player One in North America, the largest M&A in our history. We will explain the details in Chapter 3, but we believe that we were able to execute a very good M&A deal. The second was a series of public offerings. In May 2025, about 10 months after our first public offering after listing, we announced our second public offering to fund our M&A standby funds. The offering price was 969 yen, but as of today, the share price has been significantly depressed. About this point, please let us explain our revision of strategy in Chapter 2. Third, a secondary offering of a majority stake by Shin, who is former Representative Director and President, conducted at the same time as the public offering. Regarding this, we reposted the latest frequently asked questions and answers on Appendix. First of all, we would like to explain the revision of our strategy. Through our dialogue with the capital markets, we have deeply reconsidered the room for improvement in our strategy. What we initially expected was a policy of achieving continuous transformational growth through M&A in the entertainment industry, with the discipline to execute all M&A deals only those that contribute to EPS, earnings per share, improvement. Furthermore, in order to sustain this growth, we have outlined a strategy to maximize long-term shareholder value and enhance our stock price by utilizing the capital markets and continuously repeating the cycle from fundraising to the execution of M&A. What happened as a result is that, following the first public offering in July 2024, after the initial public offering price of 442 yen in July 2023, the stock price temporarily rose by 3.5 times and formed an upward trend for approximately 20 months since the IPO. However, since the confluence of events, specifically the M&A of Player One in North America under the influence of the Trump shock, consecutive public offerings, and the sale of a majority stake by the former president, the stock price has shifted into a downward trend for approximately 8 months. What was correct was that our strategy of value enhancement through consistent long-term EPS expansion was recognized and appreciated by long-term investors. All of our past M&A activities were executed with the aim of improving EPS, and as a result, we have collectively achieved results that exceeded our initial projections. We recognize that a strategy where continuous fundraising and M&A lead to rising equity value, as long as the M&A activities contribute to improving EPS, is appealing to long-term investors. In fact, shareholders with a long-term investment horizon account for approximately 80% of our shareholder register, and a prominent global representative of such investors, Capital Group, has recently increased its stake to 9.18%. On the other hand, what we miscalculated is that the cost, in the form of short-term supply-demand concerns accompanying consecutive public offerings, was heavier than we anticipated. Specifically, we recognize that the uncertainty, the concern among short-term investors that they do not know when the next public offering will occur, hindered new purchases and consequently weighed down the stock price. We deeply acknowledge this lack of foresight and will present our revised strategy on the following pages. We are revising our strategy to an M&A strategy to align with the capital markets. First, what we will not change going forward is the achievement of continuous transformational growth through M&A in the entertainment industry and ensuring that all M&A deals executed will only be those that contribute to EPS improvement. We will continue to firmly maintain these fundamental policies. On the other hand, we will change the following 3 points. The first change is a revision of our company-wide strategy concerning public offerings. Our policy is that we will not conduct the public offerings aimed at securing M&A standby funds, which we executed twice in the past, for at least next 3 years. The second change is a revision of our M&A strategy. Going forward, our M&A activities will, as a principle, first concentrate on roll-up M&A within our core business domains. Furthermore, M&A outside our core domains will be strictly selected and limited. As a result of this, we will reduce the total number of M&A deals while strictly selecting only those cases that contribute to maintaining the company's overall growth. The third change is a revision to our existing business strategy. We will strictly select growth investments in our existing businesses and aim to generate 5.0 billion yen in free cash flow, FCF, from those existing businesses in the next fiscal year. Starting from the next page, we will provide a detailed explanation of each of these points. First, we will not change the core of our strategy, achieving continuous transformational growth through M&A. As you can see, our company KPIs, revenue, EBITDA, and net income before amortization of goodwill have achieved continuous transformational growth, and we will continue to sustain this going forward. Next, the M&A discipline of M&A will be limited to those deals that contribute to EPS, will also remain unchanged. We believe you can clearly see that our adjusted cash EPS, that is, IFRS-based earnings per share excluding one-time M&A related expenses, has consistently achieved growth even while we continue our M&A activities. We believe that the target of 56.47 yen for the fiscal year ending on January 31st, 2027 can be further built upon by fully allocating the remaining portion of the M&A standby funds, which were raised in the public offering this past May, to future M&A deals. Next, on this page, we will explain the background and details of the revision of our strategy to align with the capital markets. Until now, we have been executing M&A of various entertainment companies at a high pace. In such cases, even when debt capacity was available, new financing could not practically keep up with the high pace of M&A, which necessitated the use of cash on hand. Simultaneously, we were implementing comprehensive growth investment across our existing businesses, resulting in an actively negative free cash flow. Consequently, prioritizing the speed of M&A led us to conduct public offerings for M&A standby funds for 2 consecutive years. Due to our adherence to M&A discipline, while the number of shares outstanding since the IPO has increased by 48%, our net income before amortization of goodwill for the next fiscal year has increased by 196%, resulting in a 101% increase in cash EPS, doubling it. However, continuing this strategy would have necessitated continuous public offerings. On the other hand, going forward, we will revise our M&A strategy to be one that is aligned with the capital market. First, we will strictly select M&A deals and reduce the frequency of deals. By simply lowering the pace of M&A, it will be possible to secure financing for each deal individually, allowing us to fully utilize our debt capacity. Furthermore, by strictly selecting growth investments in our existing businesses, we will generate 5.0 billion yen in free cash flow (FCF) from those existing businesses in the next fiscal year. As shown in the table on the right, our company is currently in a position to generate approximately 16.5 billion yen in FCF annually if we were to halt growth capex after paying taxes and maintenance capex. However, there are still businesses within our company where growth capex should not be halted. We will allocate those necessary growth investments from the steady-state FCF of 16.5 billion yen and still aim to generate 5.0 billion yen in FCF next year. As a result, this represents an improvement in FCF of approximately 15.0 billion yen compared to the current fiscal year. This amount is on par with the 15.4 billion yen raised in the most recent public offering for M&A standby funds. Through these strategic revisions, our policy is to not conduct public offerings aimed at securing M&A standby funds in advance, at least until the end of January 2029. Next, we would like to explain our business performance for the third quarter of the fiscal year ending on January 31st, 2026. This is the summary of the consolidated financial report, Tanshin. As an M&A company, we present IFRS metrics that exclude the amortization of goodwill, as well as adjusted income that excludes M&A-related expenses, with the aim of showing the true condition of our existing businesses. Please let us explain the areas enclosed in gold, which represent our company KPIs, on the next page. This is the summary of the consolidated statement of income. For the third quarter cumulative results, revenue was 119.6 billion yen, a plus 54% increase year-on-year, YOY. Adjusted EBITDA was 14.7 billion yen, a plus 47% increase YOY. EBITDA was 8.5 billion yen, a plus 23% increase YOY. Adjusted net income before amortization of goodwill was 5.6 billion yen, a plus 31% increase YOY. Continuing from the first and second quarters, all of our company KPIs have achieved their initial targets. The chart below shows the trend in same-store sales growth rate for our domestic amusement arcades. We are in a situation where we continue to achieve stable and strong growth exceeding 100%. This is the summary of the consolidated balance sheet. On the asset side, fixed assets increased in the third quarter due to the consolidation of acquired company assets through M&A. However, our goodwill continues to have a buffer of approximately 10.0 billion yen compared to net assets. On the liability side, interest-bearing debt reached 99.7 billion yen due to fundraising for M&A. With cash and deposits totaling 28.1 billion yen, net interest-bearing debt stands at 71.6 billion yen. However, following the strategic revision regarding the free cash flow (FCF) policy for the next fiscal year, the debt related to our existing businesses is expected to decrease for the first time starting next year. Net assets reached 63.8 billion yen, driven by the accumulation of income, public offerings, and M&A conducted using shares as consideration. Our net debt to EBITDA ratio, which indicates debt capacity, stands at 2.5 times based on the projected EBITDA of 28.0 billion yen for the next fiscal year. We judge that sufficient debt capacity remains. The detailed calculation of our debt capacity is shown below. Due to the current strategic change concerning existing business SCF for the next fiscal year, we anticipate further improvement in our overall debt capacity as the debt related to existing businesses will decrease for the first time. Next, we will provide details regarding our North American business, which we recognize as one of the contributing factors to the stock price stagnation that we explained at the beginning of this presentation. First, we will explain what we will not change and what is going well. As we explained during the second quarter earnings announcement, we are aiming for an EBITDA of 6.5 billion yen from the North American business alone in the next fiscal year, and an EBITDA of 11.0 billion yen in 2030. The most successful outcome is that, through M&A, we have gained a nationwide presence in the United States, enabling the full-scale deployment of Japanese anime IP prizes across the country. As previously reported, sales are increasing at stores that have introduced Japanese anime IP prizes. Furthermore, new store openings in major US retail chains are increasing. As we have traditionally reported, even at locations in Walmart that were closing prior to the M&A, we now anticipate over 100 new store openings next fiscal year. We are also receiving numerous inquiries for new store openings from other major retail chains across the United States. In addition, cost reduction achieved through the integration process of the various North American businesses is progressing better than expected. We anticipate a total reduction of $6.4 million, approximately 0.9 billion yen, compared to the initial assumption of $2 million, approximately 0.3 billion yen, for the full next fiscal year. Next, we will address what we will change. A challenge has materialized. The operations for restocking prizes have not kept up with the greater than expected sales growth of our Japanese IP prizes. Upon investigating the group of stores where sales declined, it was determined that the cause was the claw machines being left in an insufficiently stocked state for a long period. The root cause was the operations for restocking prizes not keeping up with the greater than expected sales growth of the Japanese anime IP prizes. When prizes were appropriately restocked in these store locations, sales significantly increased again. Since the reason for the sales decline was operational and not due to the Japanese anime IP prizes themselves, we reaffirmed the universal appeal of the sales growth narrative driven by the deployment of the Japanese anime IP prizes. Based on these findings, we will temporarily pause M&A in North America with the objective of focusing our resources on the post-merger integration, PMI, aimed at operational improvements for the time being. Here, we will explain the post-merger integration, PMI, activities we are currently undertaking. The initiative to completely replace the originally installed game machines with Japanese-style claw machines and Japanese anime IP prizes, primarily conducted at NEN, is what we call swap. The existing stores where swap has been implemented continue to maintain a high average sales growth rate of 185%. Next, the initiative to additionally install claw machines and Japanese anime IP prizes, primarily conducted at Player One, is what we call add-on. Compared to swap, which involves completely replacing a small section, add-on involves injecting these into larger amusement arcades, necessitating a different method for measuring the effect. Therefore, we compare the difference between the same-store sales growth rate for stores where the initiative was implemented and the same-store sales growth rate for stores where the initiative was not implemented. Although the numbers may appear small at first glance, because add-on is used to boost the overall sales of a large floor with the introduction of just a few mini claw machines and Japanese anime IP prizes, the increase in sales and free cash flow FCF per unit of investment is actually generating excellent results even when compared to swap. Next, we will explain the specific improvement initiatives addressing our operational challenges. The first is appropriate prize restocking. Although the growth rate of swap-implemented stores remains very high compared to our domestic business, it had begun to decrease over time. Upon investigating the cause, we determined that locations where the sales growth rate had declined were experiencing insufficient stocking in the claw machines due to delays in the prize restocking operation. The cause was that the prize restocking operations could not keep up because the prizes were selling faster than the original inventory planning assumed. Therefore, we correctly restocked the prizes at those locations and investigated the change in sales. It is important to note that this comparison is not between before and after swap of the Japanese anime IP prizes, but rather the comparison of before and after proper restocking, after swap had already been implemented. Even with this strict comparison, the growth rate improved significantly by up to 248% following the restocking. Having definitively confirmed the story of the popularity of Japanese anime IP prizes in North America once again, we will move to improve this operation as quickly as possible. In that light, the second initiative is to enhance our monitoring capabilities. We will establish a system utilizing digital transformation (DX) that allows prize restocking, which was originally entrusted to each of our rounders, to be monitored not only by the US headquarters, but also from Japan. The third initiative is aimed at standardizing quality by correcting the variation in instructional content among the sales managers who supervise the rounders. We will conduct online training for all approximately 220 sales managers to achieve this standardization of quality. And finally, we will temporarily pause M&A in North America with the objective of focusing our resources on the post-merger integration, PMI, aimed at operational improvements for the time being. Furthermore, from the perspective of prioritizing free cash flow (FCF), we will rationalize our North American business investments in the next fiscal year. First is new store openings. Due to the high expected sales of Japanese anime IP prizes from the outset, we are increasingly able to secure contracts with favorable percentage rent terms. Therefore, we will aggressively pursue new store openings from the perspective of maximizing the efficiency of our investing cash flow. We anticipate opening 600 new stores next fiscal year, and of those, we project that over 100 will be new openings at Walmart that were previously experiencing closures. At Walmart, closures were underway due to their internal policy even before the acquisition of NEN. However, after they realized the sales increase generated by the swap initiative, we were allowed to open 7 test stores, as reported during the second quarter earnings presentation. As a result, sales at those locations were extremely strong, earning positive recognition from Walmart. Therefore, we plan to proceed fully with new store openings at Walmart starting next fiscal year. Next, regarding our existing stores. As reported, the add-on initiative at Player One has a high return on investment and will be aggressively implemented. We executed this at 200 locations this fiscal year, and we anticipate 1,000 locations in the next fiscal year. On the other hand, the swap initiative centered around NEN has been completed at 1,500 locations this fiscal year. For the next fiscal year, we will temporarily suspend additional swap in principle, focusing instead on operational improvements at these 1,500 locations. We will resume additional swap once the prize restocking system has been fully established. In addition, there was an issue where, in existing stores with high percentage rent rates, the IRR, internal rate of return, would not be attractive even if swap was implemented. However, this problem has been resolved by beginning to handle large Japanese anime IP prizes, which allows us to utilize the existing large claw machines. By simply using the existing machines and stocking them with Japanese anime IP prizes, we have seen extremely high effectiveness, with the sales growth rate per machine reaching a maximum of 283%. This approach generates increased sales without requiring capex, resulting in a dramatic improvement in the IRR. We will expand this specific initiative to other existing stores with high percentage rent rates going forward. Next is the outlook for cost reduction in the North American business. The expected full-year contribution from cost reduction for the next fiscal year is projected to significantly exceed the initial assumption of $2 million, reaching $6.4 million. In Japanese yen, this equates to an annual cost reduction of approximately 930 million yen contributing to the full year's results. This chart represents the North American Midterm Management Plan. We will firmly achieve this plan, which was announced at the second quarter earnings presentation. Finally, as a question frequently raised by investors regarding the North American business, please let us provide supplementary information concerning our North American goodwill. Our total goodwill at the end of the third quarter stands at 53.6 billion yen, but as you can see, it is finely distributed. Player 1 is still in the pre-purchase price allocation, PPA, phase, and the entire amount is currently treated as goodwill. Including this, the total goodwill for the North American business is 22.8 billion yen. Goodwill impairment is expected if we are unable to recover the invested capital, the sum of this goodwill and tangible fixed assets, through cash flow within a certain period. However, the level at which we would need to consider goodwill impairment for the North American business is limited to cases where results fall significantly below the midterm management plan, as demonstrated by the gray bar chart. The primary reason for this minimal risk is that the initial acquisition prices were fundamentally cheap. The EV to EBITDA multiples at the time of acquisition were 3.6 times for NEN, 8.5 times for Player 1, and 5.0 times for Barbario and Venue Plus. While slightly higher compared to our domestic M&A, these acquisitions were made well within the safety zone. Furthermore, the fact that investment can be recouped through the sale of the game machine serves as an additional buffer. As our North American business is primarily based on the mini-location style, the tangible fixed assets consist mostly of portable game machines, with only limited amounts tied up in hard-to-sell assets like interior decorations. If results were to fall below the EBITDA level where impairment consideration is triggered, we can recover further capital by selling the game machines whose market resale value exceeds their value in use. Finally, we present the consolidated earnings forecast for Genda for the next fiscal year. Based on the M&A deals announced recently, we are once again revising upward our earnings forecast for the next fiscal year, the fiscal year ending on January 31st, 2027, as of today. Assuming no further M&A deals are executed after today, we forecast revenue of 210.0 billion yen, EBITDA of 28.0 billion yen, and net income before amortization of goodwill of 10.6 billion yen. Finally, we will explain the resolution for the 3.0 billion yen share repurchase. Regarding the share repurchase, we touched upon it briefly during the second quarter earnings presentation. Considering our EBITDA growth rate and EPS growth rate, we have determined that the current stock price level, specifically an EV to EBITDA multiple of 7.2 times and a PE multiple of 12.4 times based on yesterday's closing price, is appropriate for resolving to conduct a share repurchase. On the other hand, the amount must be within a range that does not impede our core strategy of continuous transformational growth through M&A. Therefore, we have set the total amount at 3.0 billion yen for this period. The planned execution period will run from the next business day, December 15th, 2025, until April 30th, 2026, which is after the general meeting of shareholders. Although the distributable amount is approximately 1.2 billion yen as of today, the distributable amount is expected to increase to approximately 5.0 billion yen after the completion of the extraordinary financial closing for Genda's standalone entity, which will take place in mid-December. Therefore, we can purchase up to 1.2 billion yen immediately, and the remaining amount, up to the maximum of 3.0 billion yen, will become available for purchase after the completion of the extraordinary financial closing. That concludes today's explanation. Through dialogue with the capital market, we have deeply acknowledged our lack of foresight and decided to revise our strategy. Learning from the insights gained, we will maximize the use of free cash flow, FCF, and debt capacity for M&A by strictly selecting M&A and growth investments in our existing businesses and have resolved to freeze public offerings aimed at securing M&A standby funds for a minimum of the next 3 years. However, we will continue to firmly maintain the core of our strategy, realizing continuous transformational growth through M&A in the entertainment industry and ensuring that all M&A deals contribute to EPS improvement. We sincerely request your continued support going forward. Thank you very much for your kind attention.